Welcome to another deep dive. Today, we're tackling a really big question, one that honestly could shape the future of AI and maybe, just maybe, your portfolio too.
Mhm.
We're talking about Versus AI trading as VRSSF. Is this company genuinely building the core operating system for the next wave of intelligence, what they call the spatial web?
Mm.
A technology potentially worth
Or
trillions.
is it maybe just a fascinating high-tech story burning through cash with a narrative that sounds, well, almost too good to be true?
Exactly. That's the high-stakes puzzle we're diving into today.
And we've got a comprehensive report on Versus AI Inc. that we've analyzed. Looking at things as of June 20th, 2025, their share price then was $3.80.
Right. And just a quick heads up for you listening, there's a 3-for-1 share consolidation planned around June 23rd, 2025. That'll change the ticker symbol to VRSSD, so keep an eye out for that.
Good point. So our goal here is to pull out the absolutely crucial insights from all this research.
We want to give you a clear, balanced view, the huge potential, yes, but also the very real risks involved with this kind of frontier tech company. So let's kick things off by getting a real handle on what Versus AI actually does.
Absolutely. Let's get into Chapter 1, Business Understanding, the Mind of a New Machine. What's really interesting is how Versus defines itself. They're not positioning themselves as just, another company making a specific AI tool.
Okay.
They call themselves a cognitive computing company. The aim is to provide a foundational platform, think like an operating system for intelligent systems, not just narrow AI apps.
So less like a single app, more like the Windows or MacOS for this new kind of intelligence. How do they plan to make money from that?
Their model is basically a scalable software as a service or platform as a service model, so SaaS or PaaS. They license software via subscriptions and enterprise contracts.
Flexible then.
Yeah, they seem pretty flexible. Revenue streams can be consumption-based, performance-based, or just full enterprise licenses. It gives them options.
And it sounds like this isn't just theoretical. The report mentioned some actual pilot enterprise successes.
That's right. Real-world traction. For example, there was a global investment firm that started with a beta program and then converted to a full enterprise license. That's a good sign.
And the analog example, too.
Yes, Analog, one of their partners, they saw a 32% increase in completed rides during a pilot. That's pretty significant. And now that success is apparently expanding into bigger smart city projects.
Those kinds of conversions from pilot to paying customer are critical valuation, aren't they? Shows it actually works in practice.
They absolutely are. It suggests the tech can move beyond just, promises on paper and deliver actual results. And a lot of that comes down to their main product, which is called Genius.
Genius. Okay.
Yeah, they pitch it as their flagship agentic enterprise intelligence platform. What that basically means is it lets developers build these intelligent software agents, agents that can reason, plan, and importantly, continuously learn from their environment.
That sounds, well, honestly, a lot like what other AI platforms claim. What makes Genius really stand out from, say, the large language models, the LLMs that everyone's talking about?
Okay, this is where it gets really interesting and potentially differentiating. Genius is designed to directly tackle some of the big known limitations of LLMs. Things like hallucinations.
Where the AI just makes stuff up.
Exactly. Or model drift,
Mm.
where an AI's performance gets worse over time. And also their lack of sample efficiency. LLMs often need just massive amounts of data to learn effectively.
Right.
Versus, with Genius, is focusing instead on reliability, explainability, and something they call uncertainty quantification. Basically knowing how much the AI knows or doesn't know.
Which is huge for certain industries, I imagine, like finance or healthcare.
Absolutely crucial, especially for regulated industries.
Mhm.
You just can't have a black box making critical decisions without understanding why. Genius aims to solve that.
So the goal isn't just smarter AI, it's AI that's fundamentally more trustworthy, more transparent. Makes sense. And just quickly before we move on, Versus AI Inc., that's versus.ai, is different from verse.ai, right? The SMS platform.
Correct. Good clarification. Versus.ai is the company we're talking about. Verse.ai is totally separate, does AI SMS for lead conversion. Easy mistake to make.
Got it. So looking at Versus AI's market position, the report flags them as very early stage, a microcap company.
Very much so. Market cap around $148.6 million.
Yeah.
And reported revenue for fiscal 2024 was just $1.97 million. That's tiny, frankly, compared to the scale of their ambition.
Which is nothing less than being the operating system for the spatial web, this blend of digital and physical reality.
Exactly. And their core value proposition seems twofold. Technically, it's about enabling these more reliable, explainable, efficient AI agents using their specific methodology, active inference. that's aimed squarely at the AI black box problem.
And economically?
Economically, they claim their approach, which is inspired by nature, is just fundamentally more efficient. It supposedly needs less data, less computing power.
Which could mean?
Potentially, yes. Billions in savings on GPU costs and energy for large companies. And it's a big if that holds true at scale.
Wow, saving billions. That's a massive claim. If they can pull that off, it really changes the game. So what markets are they playing in?
They're right at the intersection of two huge, fast-growing sectors.
Yeah.
First, artificial intelligence software projected to go from maybe $257 billion in 2025 to well over $1 trillion by 2033, depending on the forecast. Some say $1.46 trillion, others closer to $862 billion. Either way, enormous growth.
So, okay, AI software and the other.
Spatial computing, also booming, expected to surge from around $129 billion in 2023 to maybe $600 billion by 2032.
So Verse is essentially offering the tools, the picks and shovels for building applications in both these massive markets.
That seems to be the play. Their Genius platform is designed as this universal toolkit. Think smart cities, healthcare, logistics, manufacturing, defense, lots of different sectors.
That diversification is smart, gives them a huge potential total addressable market, or TAM. But who are they actually competing against in this space? It's crowded.
They're quite careful to say they don't compete head-on with the hyperscalers like Microsoft, AWS, Google, or even the big model developers like OpenAI.
How do they differentiate then?
It comes back to their active inference approach. They argue it solves different AI problems specifically, where things like causality, handling uncertainty, and that crucial explainability are paramount.
And they have some benchmarks to back that up. I saw something about Google DeepMind.
Yes, that was a bold claim. Their Axiom model supposedly outperformed Google DeepMind's Dreamer v3 in an Atari game benchmark. They claimed it was up to 60% better, 97% more efficient, and learned 39 times faster.
97% more efficient. That's staggering if true. A direct challenge to a giant like Google.
It is. And it's not just about the tech. They're also thinking about the rules of the game. The regulatory side is heating up for AI, and Versus seems proactive.
How so?
They're actively involved with the IE Standards Association, helping to define standards for the spatial web. It positions them as thought leaders, trying to shape responsible AI development, not just react to rules later.
Smart move. Does that, plus the specialized science, create barriers to entry, make it hard for others to just copy them?
It seems so. The barriers look formidable, primarily because of the really deep specialized scientific knowledge needed, computational neuroscience, active inference, stuff pioneered by their chief scientist, Dr. Carl Friston.
Right, the big name again.
Exactly. Plus, if they succeed in setting those IE global standards, that could become a very powerful competitive moat. It's hard to displace the standard.
So, unique science and potentially setting the standard. What else contributes to their competitive advantage? Brand. Costs.
Brand strength is still low, but growing. They've had recent features in wired and popular mechanics, which helps. But honestly, their strongest brand asset right now is probably Dr. Friston's association.
And costs. You mentioned potential efficiency savings earlier.
Right now, no real cost advantages from economies of scale. They're spending heavily on R&D. But the platform itself claims fundamental cost advantages. Less data, less compute, less energy needed. If that pans out at scale, that would be a massive structural cost advantage down the line.
And looking further ahead, if Genius does become this standard OS for the spatial web, that creates powerful network effects, doesn't it? And high switching costs.
Potentially, yes.
Yeah.
Think about it. You'd need a specialized talent pool trained on their systems. Their unique hyperspatial modeling language, HSML, would create interoperability lock-in. And migrating all your core operational logic off their platform would be incredibly expensive and difficult once you're embedded.
So the unique assets really boil down to their IP and active inference, that specific R&D team with Renee and Friston, and their leadership role in setting those spatial web standards.
That seems to be the core package, yes.
Okay, that gives us a much clearer picture of the business itself. Now, let's shift to the people actually running the show. We're moving into Chapter 2, management evaluation, the stewards of the vision. How does the leadership team look?
Well, the report points to CEO Gabriel Renee as a visionary founder. He's got a 25-year career, background in software architecture, advised Fortune 500s, and even wrote a book called The Spatial Web.
Seems deeply invested in the concept.
And interestingly, his compensation in 2024 was $435,000. That's actually notably below average for CEOs of companies this size. which often suggests, a focus on the long-term value rather than immediate payout, maybe more belief in the equity.
Skin in the game, perhaps.
Yeah.
And then there's the chief scientist, Dr. Carl Friston.
Yes, a globally recognized name in neuroscience. He's essentially the intellectual father of the active inference framework versus built on. His involvement provides a massive scientific foundation and credibility. You really can't overstate his importance to their story.
Definitely adds weight. What about the rest of the executive team?
They're relatively new, actually. Average tenure is less than a year. This reflects that recent pivot they made towards commercialization, trying to sell the product now, not just develop it.
Which introduces risk, right? Execution risk.
It does. A new team needs to prove it can execute on the commercial side. But they have made some recent additions, like Dr. David Bray, which seem aimed at bolstering credibility for that phase.
And how are they handling the financial pressures we talked about, the need for capital?
They're actively raising money, public offerings like a US $7.9 million one in April 2025, private placements, and they're doing that share consolidation we mentioned, partly eyeing a potential NASDAQ uplisting to attract more investors.
Standard playbook for a growth company needing cash. How's their communication and transparency?
Seems pretty high, actually. Lots of press releases on milestones, partnerships, customer wins. They provide financial transparency through public filings on Kedar in Canada and Edgar in the US. And as mentioned, they're involved in ethical AI initiatives via the Spatial Web Foundation and IEE.
Okay. And where are they putting the money they do raise? Capital allocation?
It's laser focused on R&D. You can see it in the numbers. R&D expenses jumped to $4.09 million in just Q1 2024, up significantly from $1.57 million the year before.
So plowing money back into development? Any acquisitions? M&A?
Nope, no M&A strategy mentioned. Seems purely organic development. And critically, because they're not cash flow positive yet, they are completely reliant on the capital markets for funding.
Which means no share buybacks or dividends, obviously.
Correct. Entirely appropriate for their stage. But it does mean shareholders who got in early have faced significant dilution as the company issued more shares to raise funds. That's a key risk.
A necessary evil for this kind of venture, perhaps. What does this all do to their return on invested capital, their ROIC?
Oh, it's deeply negative, like negative 1,710%. That reflects this intense pre-commercial R&D phase. Their operating loss for fiscal 2024 was over $40 million.
So the entire investment case here is really a bet that this number flips dramatically positive in the future?
Precisely. It's a bet that eventually this business will generate huge positive net operating profit after tax or NOPAT, the core earnings power. But right now, it's all investment, no return.
Okay, let's dig into those financials more because, compelling story aside, the numbers need to work eventually. We're on to Chapter 3, financial analysis, the numbers behind the narrative.
Right. Starting with market cap, it's about $148.6 million. As we said, firmly in microcap territory. For you listening, that just inherently means higher risk, higher volatility.
And the revenue growth trends over the last few years.
They're nascent and pretty volatile. FY22 was $2.77 million, then it dropped to $1.61 million in FY 2023, then back up slightly to $1.97 million in FY 2024.
Not exactly a smooth upward curve. Tiny numbers and they're bouncing around. That doesn't scream predictable growth yet.
Not yet. The historical figures aren't really the main story here. It's all about the future revenue potential, especially now that Genius is commercially launched. But yeah, the past performance is minimal.
What about profit margins? Gross margin first.
Extremely low, around 4.9% to 5.24% for Q1 2024. That is really uncharacteristic for a scalable software business, which usually has very high gross margins. It suggests most of their current revenue is from project-based work or services, not scalable software licenses yet.
So the bull case needs that to change dramatically. They need to shift to high-margin software licenses.
Exactly. That's a core assumption. And as you'd expect, operating and net margins are profoundly negative. Operating loss was made to $40.14 million, net loss made of $46.61 million for FY 2024. Just reflects those heavy investments in R&D and starting up operations.
Okay, and the lifeblood metric, free cash flow?
Consistently negative, and actually getting more negative. It was made to $29.44 million for FY 2024. This accelerating cash burn is probably the single biggest financial risk right now.
Creates a ticking clock, you said.
Absolutely. They need significant commercial wins, or they need to keep raising money, likely diluting existing shareholders further, just to keep the lights on.
Which brings us to financial stability. It sounds precarious. They're losing money. Losses are widening. And you mentioned negative shareholder equity.
Yes, negative $6.19 million as of March 31st, 2024. Liabilities exceed assets on the balance sheet. From a purely accounting perspective, that signals technical insolvency.
So they're essentially running on market faith, belief in their IP and their ability to keep raising capital.
That's a fair way to put it.
Yeah.
Their current ratio, which measures short-term liquidity, is also critically low at 0.14. They have very few liquid assets to cover immediate debts, makes them utterly dependent on that recent financing and any future fundraising.
And obviously no dividends, not applicable here.
Right.
So how on earth do you value a company like this? PE is out due to losses. What about price to sales?
Well, based on that $1.97 NIP of revenue, the PS ratio is roughly 75x. Some calculations put it even higher, maybe 172x. Either way, that is extraordinarily high.
A classic story stock valuation then. Price for perfection or massive future growth.
Exactly. The market isn't valuing the current business. It's pricing in huge, exponential growth for years to come.
What about intrinsic value? Can you even do a DCF, a discounted cash flow model?
It's incredibly speculative. You have no history of positive free cash flow to base it on. Any DCF would be pure guesswork about the distant future.
Like forecasting next decade's weather based on today.
Pretty much. Just for illustration, one platform did attempt a calculation, likely based on multiples or future projections, and came up with an intrinsic value of just 12 cents.
Wow. Compared to the $3.80 share price, that highlights the enormous gap between current financials and market expectation.
It really does. To even begin to justify the current price, you need incredibly aggressive assumptions like 50, 100% annual growth, maybe more, for many years, plus a really high discount rate, 20%, 30% or more, to account for the extreme risk.
So just to recap those key metrics, market cap $148.06, share price $3.80, FY24 revenue $1.97 EPS, net income managed $46.61, operating cash flow managed $29.44, total equity managed $6.19, current ratio 0.14, PS ratio 75x. It's stark.
It paints a very clear picture of the financial situation, yes. High hopes, high risk, currently very little fundamental support.
It certainly does. Okay, let's shift gears and look at how the wider market sees it versus AI. We're into part 2, starting with chapter 4, market sentiment, the crowd's verdict. What's the general feeling out there?
Well, first off, there's basically zero formal analyst coverage from the big Wall Street investment banks.
Which usually means
It's too small, too speculative, or maybe just too complex for traditional sell-side research right now. If you see buy ratings online, they're likely algorithmic, not based on deep fundamental analysis.
But the news flow seems pretty positive, doesn't it?
It does. It's dominated by their own announcements hitting technological milestones like that XIOM benchmark against Google, strategic partnerships like with Soothsayer and Analog, the commercial launch of Genius.
And getting features in places like Wired and Popular Mechanics helps build that narrative too.
Definitely. The market sentiment seems largely fueled by this forward-looking story, this potential, rather than their past financial performance, which leads us to short interest.
Which is really high. The report mentioned a 60-80% short volume ratio.
Yeah, significant short interest. This indicates a strong group of investors betting against the company. They're focused squarely on those financial weaknesses we just discussed. The cash burn, the consistent losses, the negative equity, the need for dilutive financing.
Creates a real tug of war in the stock, drives that volatility we talked about.
Exactly. But it also sets up the potential for a short squeeze. If some really good, unexpected news hits, those short sellers might rush to buy back shares to cover their positions, which can rapidly drive the price up.
So a classic battleground stock. What are the technical indicators saying? Price relative to moving averages.
It's a mixed picture, actually. The stock is trading below its 50-day moving average, sits around $4.96. That's typically seen as a short-term negative or sell signal.
Okay, but
But it's trading above its 200-day moving average, which is around $3.53. That's generally considered a longer-term positive or buy signal.
so short-term bearish, long-term bullish according to those averages.
That's how you could read it. It reflects that battle we see between the long-term believers in the story and the short-term traders focused on the financials. Lots of uncertainty reflected there.
Makes sense. That tension is palpable. Okay, let's look at who actually holds the shares. Chapter 5, ownership structure. Who's at the table? Who owns versus AI?
This is fascinating. Institutional ownership is practically non-existent. We're talking 0.01%. And the single institution that was recorded seems to have sold its position.
Wow, 0.01%. Why so low?
It's mostly due to institutional rules or mandates. Many funds simply can't or won't invest in over-the-counter OTC stocks or companies that are unprofitable, have negative equity, or such small market caps.
Which is exactly why management wants that NASDAQ uplisting, right, to become eligible for institutional money.
Precisely. That's a major strategic goal to attract those bigger, potentially more stable investors,
But the flip side of that is insider ownership.
which is extremely high, around 49%. The CEO, Gabriel Rene, holds about 13.2% himself.
49%. That's huge. That shows massive alignment between management's financial interests and shareholder interests, doesn't it? They really have skin in the game.
A significant amount. And it's not just historical holdings. Insiders have actually participated in recent financing rounds, buying more shares. For example, an officer bought 50,000 units in a private placement back in September 2024. That shows real conviction, putting more of their own money in.
So ownership is highly concentrated then, mostly insiders and retail investors.
Very much so. With institutions largely absent, it's insiders and the public, the retail crowd. The public float the shares readily available for trading is relatively small, about 19.2 million shares before that consolidation.
And that concentration adds to the volatility.
Definitely. Retail sentiment can swing quickly, and with a small float and high short interest, you get these big price movements. Post-consolidation, the shares outstanding will be even lower, around 8.7 million, potentially concentrating ownership further.
Okay, clear ownership picture. Now for the really critical part, weighing everything out. Chapter 6, risk assessment. Navigating the headwinds. Let's use a SWOT analysis. Strengths, weaknesses, opportunities, threats. What are the core strengths?
Strengths are internal positives. So number one is their proprietary technology active inference, claiming efficiency and explainability. Number two, world-class scientific leadership with Dr. Carl Friston. Three, a visionary founder in Gabriel Rene. And four, that very high insider ownership, around 49% aligning incentives.
Okay, and the weaknesses, the internal negatives.
These are significant. Extreme financial fragility, the negative equity, high cash burn, growing losses, their dependence on capital markets just to survive, an unproven commercial model at scale, minimal revenue so far, and a relatively new commercial management team that still needs to prove they can sell this thing.
That's a heavy list on the weakness side. What about opportunities, external positives?
The opportunities are potentially enormous. First, the massive total addressable market in AI and spatial computing. Second, the potential power of their platform as a service model, high margins, network effects, switching costs if they become embedded. Third, that potential NASDAQ uplisting could unlock visibility, liquidity, and institutional investment. And fourth, strategic partnerships act as crucial market validation.
And the threats, external negatives they face.
Big ones here too. Intense competition from the AI giants Google, Microsoft, OpenAI, and others. The ever-present threat of technological obsolescence AI moves incredibly fast. Significant execution risk just failing to commercialize successfully.
Plus macroeconomic stuff.
Yes, those are real threats too. High inflation increases their costs, salaries, cloud compute making the cash burn worse. Higher interest rates hurt growth stocks badly. They increase the discount rate used in valuations, crushing the present value of distant future cash flows. Plus, it makes raising new capital more expensive.
And any specific geopolitical risks, like those U.S. tariffs from 2025.
The direct threat seems low there. Tariffs usually hit physical goods. Electronically transmitted software or digital services, like versus AI offers, are generally not subject to those kinds of tariffs, especially under agreements like USMCA. Broader trade tensions could have indirect effects, but it's not a primary threat to their core model.
All right, we've covered a lot of ground. Let's try to bring it all together now. Chapter 7, Conclusion. Can you synthesize the key bullish points? What's the core bull case for versus AI?
Okay, the bull case really rests on a few pillars. First, they potentially have a technologically superior and defensible platform thanks to active inference, offering explainability and efficiency that others might lack. Second, they're targeting an absolutely massive TAM, potentially the foundational layer for multi-trillion-dollar AI and spatial web economies.
Yeah.
Third, they have a potentially powerful, scalable business model. PaaS, high-margin recurring revenue, network effects, high switching costs. Fourth, they have visionary and highly aligned leadership, Rene, Friston, and that huge insider ownership. And fifth, there are early tentative signs of validation, like the benchmark results and those pilot to enterprise conversions.
That's the dream scenario. Now, give us the flip side. What are the key bearish points? The reasons this could all go wrong?
The bear case is equally compelling, maybe even more immediate. First and foremost, the extreme and urgent financial risk. They are unprofitable, burning cash at an accelerating rate, have negative equity, and are totally dependent on raising more capital.
Which leads to?
Inevitable shareholder dilution from that ongoing fundraising. Second, their commercial model is still unproven at scale, as is their ability to ramp up sales effectively. Third, the almost complete lack of institutional validation is a major red flag for many investors. And fourth, the valuation is highly speculative, volatile, and completely detached from current financial fundamentals.
So let's revisit that valuation point. Traditional metrics just don't apply. The $3.80 price is way out of line with current reality.
Right. That illustrative $0.12 CAD intrinsic value calculation just underscores the massive gap. The market is pricing in an incredibly optimistic future, ignoring the present financial state almost entirely.
So how should we think about an investment here then?
At the end of the day, an investment in versus AI right now is basically a venture capital style bet on a high-risk, high-reward outcome. That's really the best way to frame it. Meaning the potential upside is enormous, truly transformative, if they execute flawlessly on this incredibly ambitious vision and if their technology becomes as foundational as they hope. But the risk of significant or even total capital loss is just as real. If they can't gain commercial traction fast enough, if the funding dries up before they reach profitability, or if a competitor simply out-innovates or outmarkets them,
Right.
it could go to zero. The outcome feels very binary, huge success or complete failure.
A real make-or-break situation. So that leaves a big question for you, our listener.
We want to leave you with this thought to chew on. In a world that's becoming increasingly driven by AI, how much value will you ultimately place on an AI system that claims it's inherently more explainable, more trustworthy, and more efficient? What does that really mean for the next generation of intelligence systems and for the companies like Versus AI trying to build them?
Something to really think about. And if this deep dive helped you think, please like and subscribe to Stock Analytics AI. Don't forget, our $499 a month members get priority deep dives on tickers, and over the next few months, we are covering all of the S&P 500 stocks exclusively for members.
And finally, the important reminder. This analysis was generated by an AI system for educational purposes only. It should absolutely not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.